On May 29, 2026, 5 days ago, Statistics Canada released Canada's Q1 GDP report. The headline, Canada's real GDP fell 0.1% on an annualized basis in the first quarter of 2026. That followed a revised 1.0% contraction in Q4 2025. Two consecutive quarters of negative GDP growth. By the most common definition, Canada is now in a technical recession. Here's what that actually means for you, because most Canadians hear the word recession and immediately think of 2008. Job losses, foreclosures, markets crashing, the kind of economic devastation that takes years to recover from. That is not what this is. The BMO chief economist called it a trade-induced technical recession, and said it was likely already over. Capital Economics stated the economy was already tracking for a solid rebound in Q2 2026, with April GDP already showing plus 0.4% growth in the mining, quarrying, and oil and gas sectors. The OECD projected just this week that Canada's GDP growth will strengthen to 1.2% by end of 2026 and 1.7% in 2027. But here's the reality. Even a shallow recession has real consequences. Canada lost 112,000 private sector jobs since the start of 2026. Youth unemployment sits at 13.8%, barely off its September 2025 peak of 14.6%. Business investment fell 0.7% in Q1 2026, its fifth consecutive quarterly decline. And Canadian households already carry the highest debt-to-income ratio in the G7, approximately 174%, meaning a slowdown hits harder here than almost anywhere else. The question is not whether this is technically a recession. The question is, what do you do with your money right now? This video gives you 5 specific moves, backed by the data released this week, to protect your finances, reduce your risk, and position yourself to benefit from what comes after. Let's be precise about what happened on May 29th, because the gap between what technical recession means and what most Canadians fear when they hear recession is significant. What a technical recession is: 2 consecutive quarters of negative real GDP growth. That's it. It's a technical definition used by economists and investors. Canada's Q4 2025 contracted at 1.0% annualized. Canada's Q1 2026 contracted at 0.1% annualized. 2 consecutive quarters. Technical recession. Box checked. What it isn't: a catastrophic economic collapse. The Q1 2026 decline was essentially zero on a quarter-over-quarter basis. The annualized rate magnifies small movements. GDP by industry actually rose 0.1% in Q1. Services-producing industries grew 0.3%. The recession debate is genuine. Multiple economists, including TD's Mark Ercolau, said they wouldn't necessarily call it a technical recession, given how marginal the decline was. The context that matters: Canada's economy grew plus 2.6% annualized in Q3 2025, just 2 quarters before the contraction. The economy isn't in freefall, it is stalling, specifically because of the trade war disruption created by U.S. tariffs. BMO chief economist Doug Porter put it directly: there is little debate that the economy has struggled to make any headway over the past year amid the ongoing trade conflict. The likely trajectory. Statistics Canada's early estimate for April 2026 shows GDP rebounding plus 0.4%. Driven by oil and gas sector recovery. Capital Economics says the trade-induced recession was likely already over. The OECD forecasts 1.2% growth by end of 2026. Business investment fell 0.7% in Q1, its fifth consecutive quarterly decline. But the expectation is gradual recovery as tariff uncertainty resolves. What this means in practice: this is not the recession of your worst nightmare. It is the recession of genuine but manageable economic stress. Job market softness, cautious businesses, household financial pressure. It requires specific protective financial moves. It does not require panic. The 5 moves in this video are calibrated to the specific conditions of this recession, not a generic what to do in a downturn list. Every one of them is drawn from what the 2026 data tells us about where the real risks are. Your action step: check where you stand on the 3 key personal vulnerability indicators for this recession. Your job security in a tariff-exposed or discretionary spending industry, your current emergency fund size relative to your monthly expenses, and your current debt load. Those 3 variables determine your personal recession risk more than any GDP number. The 5 moves are sequenced deliberately. The first 2 are defensive. You build the foundation that protects you from the worst-case scenario before you think about anything else. The remaining 3 are offensive, positioning yourself to benefit from what comes after. Move 1. Build or top up your emergency fund to 6 months. Today, in any recession, but especially in a tariff-disrupted economy where job losses are concentrated in goods-producing industries, your emergency fund is the most important financial asset you own. Canada lost 100 to 12,000 private sector jobs since the start of 2026. Full-time work fell by 111,000. The goods-producing sector, manufacturing, construction, agriculture, energy, was hit hardest. If your income comes from any of these sectors, your personal recession risk is meaningfully higher than the national average. The standard emergency fund recommendation is 3 to 6 months of core expenses. In this environment, 6 months is the target. If your job is in a tariff-exposed industry, manufacturing, steel, auto, lumber, agriculture, consider 9 months. Where to hold it: EQ Bank or Wealth Simple Cash, currently earning 3.5% to 4.5%. Your emergency fund earns real passive income while remaining fully liquid, not a TFSA invested in equities, fully liquid cash, or HISA. The math of not having an emergency fund in a recession. Without one, a job loss forces you to either sell investments at potentially depressed prices or go into high-rate credit card debt. Both outcomes permanently damage your long-term financial position. The emergency fund is the circuit breaker that prevents both. Move 2. Aggressively pay down high-rate consumer debt. Canada's households spend approximately 9% of disposable income on interest payments alone, even before touching principal, according to EDC's 2026 analysis. In a slowing economy where wage growth is constrained and job security is reduced, that 9% interest drag becomes even more suffocating. High-rate consumer debt, credit cards at 19.99% to 22.99%, store cards at 24% to 29%, is the most dangerous financial liability to carry into a recession. Here's why. In a recession, incomes can fall. Debt costs stay fixed. The combination of falling income and fixed high-rate debt is how financial stress becomes financial crisis. The guaranteed return on eliminating 20% credit card debt is 20%, better than any investment available in any market environment. In a recession, That guaranteed return is more valuable than any speculative market upside. If you are carrying high-rate debt, the recession is not the time to invest aggressively. It is the time to eliminate the 20% liability before it eliminates your financial stability. Your action step. This week, check your emergency fund balance against 6 months of your core expenses. Then add up your total high-rate consumer debt and the monthly interest you're paying. Those two numbers define your immediate financial priority. Move 3 is not something you do, it's something you don't do. Do not sell your investments. This sounds simple. During a recession, when markets are falling, when news is negative, when your portfolio is down, it is psychologically the hardest thing to hold, and it is financially the most important. Here's the data that makes this concrete. Missing just the 10 best trading days in the S&P 500 over a 20-year period can cut your returns roughly in half. Those 10 days, out of approximately 5,000 trading days, almost always occur during or immediately after market downturns. The investors who sell during the decline are almost always out of the market when those recovery days happen. The TSX was up 31.63% year-over-year as of June 1, 2026. The investors who held through every dip, including the tariff shock in early 2025, captured that return. The investors who sold at the bottom locked in permanent losses and missed the recovery. Every recession in Canadian and global history has been followed by a recovery. Every single one. The 2008 financial crisis, the worst in a generation, was followed by the longest bull market in history. The 2020 pandemic crash, the fastest drop in market history, was followed by one of the fastest recoveries. The practical mechanics. When your portfolio drops in value during a recession, the underlying businesses you own have not necessarily become less valuable permanently. A TFSA invested in XEQT, holding 9,000-plus global companies, is not worth less because Canada's GDP fell 0.1% in one quarter. The short-term price movement and the long-term business value are different things. What actually damages wealth in a recession is not the portfolio declining. It's locking in that decline permanently by selling, and then having insufficient cash to buy back in before the recovery. This is exactly why Move 1, the emergency fund, comes first. The emergency fund ensures you never have to sell your investments for cash. You sell nothing. The portfolio weathers the storm. The recovery does the rest. Your action step. Right now, look at your TFSA portfolio. If it is down from recent highs, that is expected and temporary in a shallow recession. Do not sell. If anything, and only if your emergency fund is fully funded and you have zero high-rate debt, consider increasing your monthly automated purchase. Move 4 addresses the most significant personal risk in any recession. Job loss. Canada lost 112,000 private sector jobs since the start of 2026. The goods-producing sector was hit hardest. Retail service workers are typically the first affected in discretionary spending contractions. And Canada's business closure rate has been running above pre-2020 historical norms. Here is the proactive approach to recession-proofing your income. And it is not just update your LinkedIn. Step 1. Understand your personal sector risk. Tariff-exposed industries face the highest layoff risk in this specific recession. Manufacturing, auto, steel, aluminum, lumber, agriculture, and any business heavily dependent on U.S. export revenue. If you work in these sectors, your recession risk is materially higher than the national average. That means 9 months of emergency fund, aggressive debt elimination, and skills diversification are all more urgent. Services industries, financial services, healthcare, technology, education, government face lower structural recession risk in this environment. Services-producing industries grew 0.3% in Q1 2026, while goods-producing fell 0.4%. Step 2. Build a recession-resistant skill stack. Recessions typically affect retail service workers more, as discretionary spending is often the first thing households cut amid economic uncertainty, according to Nesto's 2026 Recession Guide. Skills that are harder to automate in industries that are countercyclical or recession-resistant provide meaningful protection. In a Canada where 74% of goods exports go to the U.S. and trade relations are uncertain, skills tied to domestic service delivery, digital infrastructure, healthcare, and government are more protected than skills tied to export manufacturing. Step 3. Diversify your income streams before you need to. The worst time to build a second income stream is after you've lost your first one. The best time is now, when you have the income and the runway to experiment. Even $500 per month in dividend income from a TFSA invested in VDB at 4.5% yield means that a portion of your income is permanently decoupled from your employment status. It arrives whether you're employed or not. Dividend income doesn't replace a salary in a crisis, but it reduces the urgency of a crisis, and that reduction in urgency is worth more than its dollar value in a moment of stress. Step 4. Know your EI entitlement. Employment insurance in Canada replaces approximately 55% of eligible income, up to a maximum insurable amount. If your income is above $63,200 in 2025, the maximum insurable earnings threshold, I will not replace 55% of your full salary. Know your entitlement before you need it. Maximize your EI contributions through your employment. They are mandatory deductions, and understand the qualifying period requirements for your province. Your action step: identify your personal sector risk honestly. If you're in a high-risk sector, accelerate Move 1 and Move 2 immediately. Then research EI eligibility and consider whether a skills upgrade in a more recession-resistant direction is worth pursuing now. Here is the move that most people miss, because they're too busy managing the downturn to prepare for what comes after. Every recession creates a recovery, and the people who position themselves correctly during the recession, while everyone else is in survival mode, are the ones who build disproportionate wealth in the years that follow. Here's what the 2026 data tells us about the recovery. The OECD projects GDP growth strengthening to 1.2% by end of 2026 and 1.7% in 2027. Capital Economics says the April 2026 GDP data is tracking for a solid rebound. The Bank of Canada has cut rates 9 times, from 5% to 2.25%, and those cuts take 12 to 18 months to fully flow through to economic activity. Rising oil and gas prices tied to the Middle East conflict are expected to provide a lift to Canadian GDP in coming quarters. Canada's position as a net energy exporter becomes an advantage as energy prices rise. What positioning for the recovery looks like in practice? Keep buying your TFSA ETF every single month. The investors who continued automated monthly purchases through the 2020 pandemic crash bought units of XEQT and VDY at dramatically discounted prices. Those units, purchased during the fear, compounded through the recovery that followed. This is the most powerful wealth-building scenario in investing: buying the same asset cheaper during a temporary downturn. Consider adding to dividend ETF positions. When the TSX dips during a recession, dividend yields on existing holdings increase because the price falls, but the dividend payment stays fixed. This is called yield on cost expansion, and it means recession buying of dividend ETFs locks in permanently higher yields. A VDY unit bought during a 10% market dip yields approximately 5%, rather than 4.5%. And that higher yield is permanent for units purchased at that price. Use the RRSP refund while you can. If your income has dropped due to recession conditions, your marginal rate may be lower this year than in previous years. A lower marginal rate means the RRSP deduction generates a smaller refund. If your income has not dropped, maximize your RRSP contribution this tax year before it closes. The refund generated at your current income level may be higher than in future years if the recovery brings income growth. Build the FHSA if you haven't yet. In a real estate market where prices have softened, the FHSA's $8,000 annual contribution is building your down payment at the same time the market is giving you a more accessible entry point. Recession real estate conditions are historically among the best buying opportunities for long-term homeowners. The historical pattern of recovery. In every recession since 1980, the Canadian stock market recovery has exceeded the pre-recession peak within 1 to 4 years. The investors who held, continued buying, and avoided panic selling ended every cycle substantially ahead. Your action step. Map out what you would do differently if the recovery starts tomorrow. Then start doing those things today, because the recovery may already be underway. April GDP tracking at plus 0.4% suggests the recession may have been over before it was officially announced. Let's come back to May 29, 2026. Statistics Canada confirmed 2 consecutive quarters of negative GDP growth. Canada is in a technical recession by the most common definition. GDP barely contracted, 0.1% annualized in Q1, essentially zero on a quarter-over-quarter basis. The OECD projects recovery to 1.2% growth by end of 2026. April GDP is already tracking positive. This is not 2008. It is not a structural economic collapse. It is a trade-induced stall, driven by tariff disruption in an economy that grew 2.6% annualized just 2 quarters ago and has a recovery already beginning to take shape. But the real risks are genuine. 112,000 private sector jobs lost. Youth unemployment at 13.8%. Business closures above historical norms. Household debt at 174% of income, with 9% going to interest alone. Those numbers are real, and they require a real response. Here are the 5 moves one more time. Move 1. Build your emergency fund to 6 months. 9 months if you're in a tariff-exposed industry. EQ Bank or Wealth Simple Cash at 3.5% to 4.5%. Move 2. Eliminate high-rate consumer debt. A guaranteed 20% return beats every investment in any economic environment. Move 3. Do not sell your investments. Every recession ends. The investors who hold through it capture the recovery. The ones who sell lock in the losses permanently. Move 4. Recession-proof your income. Know your sector risk. Understand your EI entitlement. Build a second income stream before you need one. Move 5. Position for the recovery. Keep buying your TFSA ETF. Add to dividend positions during the dip. Use the RRSP before year-end. Build the FHSA if eligible. The recession is real. The recovery is coming. The 5 moves protect you through the first and position you for the second.